What I'm focused on and what they should be looking at is real rates. Real rates are going to be falling because inflation is going to be rising and the Fed's not going to hike. We're not going to get hikes. And the fact that we're not going to get hikes when we should get hikes because inflation is going up means real rates are going down. And that is very good for gold. It's bad for the dollar. The markets have got this completely wrong. And that's the opportunity, again, for my listeners to keep buying gold. It's a steal at $2,700. Silver is an even bigger steal at $31. So make sure and contact Schiff Gold and buy before the next big move up.
Renowned market analyst Peter Schiff highlights exciting news for gold enthusiasts. Recent inflation trends and data are shaping a promising landscape for the precious metal. With U.S. Treasury yields on the decline and core inflation easing, gold has seen impressive gains for several days. The future looks bright for gold. The latest Consumer Price Index data from the Bureau of Labor Statistics revealed mixed signals. While headline inflation rose to 2.9% in December 2023 from 2.7% in November, marking the third consecutive monthly increase from September's 3.5-year low of 2.4%. Underlying price pressures showed signs of moderation. The increase was primarily attributed to rising prices in specific sectors, including gasoline, eggs, and used vehicles. Market participants interpret this data as supportive of the Federal Reserve's potential monetary policy easing. Current trading patterns suggest expectations of approximately 40 basis points in rate reductions by the end of 2025. This outlook has contributed to downward pressure on U.S. Treasury yields, which are traditionally a positive catalyst for gold prices. Schiff contends that the current market environment offers a strong opportunity for investors in precious metals. He points out that ongoing inflationary pressures, coupled with potential political limitations on Federal Reserve policy, could create a situation where real interest rates decline. This is because the central bank might be reluctant to implement the necessary rate hikes. However, market observers note potential headwinds for this outlook. Political considerations, particularly regarding future trade policies under a potential Trump administration, could introduce new inflationary pressures through proposed tariffs. Such developments might complicate the Federal Reserve's ability to implement monetary easing, potentially affecting gold's trajectory. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Instead of looking at these, lagging indicators, just look at the boom in commodity prices that was going on today, yesterday, the day before. I've never seen commodity prices rising like this. Gold prices were up about $20 today. We're back at 2,700. Silver had a really strong day, was up about 70 cents. We're up about another dime this evening. We're almost at $31 again. We're at $30.80, so back above 30. Despite that, most silver stocks were down, 1, 2, 3% today. Gold stocks were barely up. Again, nobody wants to buy gold stocks because everybody is so optimistic on the economy because they think everything's going to be great now that we've reelected Trump. Again, everybody is in for a huge disappointment when the problems that got Trump elected get worse after he's elected, right? They were going to get worse anyway. I'm not saying it's Trump that's going to make them worse. It was going to happen, and Trump isn't going to do anything to stop that. But what's happening with inflation is very good for gold. It's very good for gold stocks because it's going to result in a fall in real interest rates. See, everybody is focused on what's going to happen to nominal rates. Is the Fed going to cut? Are they not going to cut? What I'm focused on and what they should be looking at is real rates. Real rates are going to be falling because inflation is going to be rising and the Fed's not going to hike. There's no way that the Fed is going to start hiking during Trump's first term. It's just not going to happen. Could you imagine, what would happen? The vitriol, the rhetoric, what Trump would be saying about Powell if, he steps into office and Biden and Powell just starts hiking rates, right? Trump immediately comes in and they start hiking rates. So it's not going to happen. Rates aren't going up. They may hold off on the cuts until we really get a big, collapse in the jobs market. But we're not going to get hikes. And the fact that we're not going to get hikes when we should get hikes because inflation is going up means real rates are going down. And that is very good for gold. It's bad for the dollar. the markets have got this completely wrong. And that's the opportunity, again, for my listeners to keep buying gold. It's a steal at $2,700. Silver is an even bigger steal at $31. So make sure and contact Schiff Gold and buy before the next big move up. There's a bubble in almost every asset class that you can imagine, right? Including Bitcoin, which is still, hanging out at 100,000. There's a bubble in everything except gold mining stocks. In fact, it's the opposite of a bubble. There's extreme pessimism. Even today, they couldn't get a rally. With a big rally in gold and a big rally in silver, they are giving these stocks away. Nobody wants them. And of course, when nobody wants something, that's when you want to buy it. When everybody wants something, that's when you want to sell it. That's what's going on with a lot of these tech stocks, with a lot of the cryptocurrencies. So you need to be a contrarian if you want to make money in the long run. Anyway, we got a quick commercial break. I'm going to go over some more inflation news and get into the jobs numbers that came out on Friday.
The recent dynamics in the U.S. financial markets present a complex interplay between monetary policy inflation concerns and market reactions. The bond market has demonstrated notable volatility, with the 10-year Treasury yield surpassing 4.80%, reaching levels not seen since 2023. This surge has created ripple effects across financial markets, particularly impacting U.S. equity indexes, which have retreated from their recent record highs. The apparent disconnect between the Federal Reserve's monetary policy actions and market behavior makes this situation particularly noteworthy. Despite the Fed implementing 3 interest rate cuts since September, totaling a full percentage point reduction, bond yields have moved in the opposite direction of what might typically be expected. This divergence underscores a fundamental principle of financial markets. Peter Schiff's analysis highlights what he sees as a contradiction in the Federal Reserve's approach to managing inflation. The market surge was prompted by the release of what many interpreted as positive inflation data, suggesting that an interest rate cut could occur as early as March. Let's get back to the interview.
We got a big rally in the markets today. The Dow was up just over 700 points. That's about 1.6%. Russell 2000 did even better, up 2%. The star was the NASDAQ, up 2.5%. Of course, we had a rally in the bond market as well. The bond market yesterday made new lows and yields made new highs. We had the yield on the 10-year government bond at Treasury at 4.8%. And the 30-year was back at 5%. But we had a rally today, which sparked a rally in the stock market because the government released what was, purported to be good news on inflation, right? We got a benign inflation report. We got a report that was better than expected. And by better, I mean lower, right? We got less inflation than was expected. And this is what ignited the boom. We had a big increase in the probability that we're going to get, a March rate cut now that we got this good news on inflation. Well, what was the good news on inflation? Because the expectation, and this is the December number, so it is the final number of 2024, and the estimate was for an increase of 0.3, and we got an increase of 0.4. What's the good news about that? 0.4 is higher than 0.3. Now, the range of estimates was anywhere from 0.2 to 0.4. So it wasn't above the highest estimate, but it was the highest estimate, and it was higher than the previous month. And I think more significantly, if you take 0.4, which is 1 month, and you annualize that, let's say the next 12 months are the same as the report we just got. That's 5% inflation. 5%. That's a big number. That's more than double the Fed's 2% target. So how are we celebrating? Why did Wall Street look at what is a bad number and somehow decide that it was a good number and have a big rally party? Well, it's because the core number, right? And before I get to the core, let's talk about the year-over-year CPI, which was up 2.9%. That is 0.2 tenths hotter than the year-over-year from November. So we're moving in the wrong direction. Now, yes, the expectation was 2.9, and we got 2.9, but 2.9 is a long way from 2. Remember, when inflation was below 2, and the Fed was like, oh my God, this is an emergency. We're below target. We need 0% interest rates. We need to do quantitative easing. We really need to get inflation higher. it was like 1.5, 1.6, 1.7. And the Fed was like, that's not enough. We need to get to 2. Well, we were a lot closer to 2 then from the downside than we are now from the upside. So why isn't the Fed equally as vigilant when we're 0.9 away from 2? We're 2.9, right? I don't even know if we ever got as low as 1.1, right? So we're at 2.9. We're almost a full percentage point away from the target. Why aren't they being as aggressive to get inflation down as they were to get inflation up? It just shows you how disingenuous this whole thing is. They're actually cutting rates, when inflation is 2.9, and it's heading in the wrong direction.
The interplay of economic data, monetary policy shifts, and market reactions is shaping a complex landscape for precious metals and broader financial markets. As investors weigh the implications of persistent inflation, potential rate adjustments, and political uncertainties, the outlook for gold and other safe haven assets remains a pivotal point of discussion. Navigating these dynamics requires careful analysis and a forward-looking approach. What strategies do you think investors should adopt to balance opportunities and risks in the evolving economic environment? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.